Gold and silver are in an absolute free fall at this very moment. Not a gradual decline, not a minor retracement, not a period of consolidation. This is a full-blown, uncontrolled plummet. As I record this, gold has just breached 4,600. Silver is sitting at 72. And every few moments when I refresh my screen, the figures are even lower. 45.50, 45.20. There is no sign of a pause. This has moved beyond a simple correction. What we are witnessing is an active crash, a collapse unfolding in real time as you watch this video. Friday was presumed to be the climax of the sell-off. Silver down 38%, gold down 16%, the most severe single-day plunge in 45 years. The consensus was that it was over. Everyone believed the selling pressure was spent. Everyone was convinced the bottom had been established. What we are seeing now is pure liquidation, forced selling, a chain reaction of margin calls rippling through the financial system, one after another. Traders are being obliterated, position by position, account by account. And the velocity is increasing, not diminishing. It is accelerating. Welcome to the hidden economy. If this is your first time here, my channel reveals the true dynamics moving markets while everyone else is preoccupied with surface-level headlines. Subscribe immediately because the analysis I provide is simply unavailable anywhere else. And if you find this content valuable, please hit that like button hard. It signals the algorithm to share this with more people who require this insight. Now, in my last video, I precisely outlined the critical level of 117, where silver's previous breakdown initiated. At that time, many commenters insisted, look, it's rising to 118, to 120. Regardless, before I present the data, understand what occurred this morning at the market open. Thousands of traders attempted to sell their silver ETF holdings. Their orders were rejected. A circuit breaker was triggered. Friday's collapse was so extreme that current prices remain beneath the circuit limit. The exchange is refusing to accept sell orders. Individuals who held through the weekend, hoping to exit on Monday morning, are now ensnared. They cannot sell at any price. The system is physically preventing them. This is happening right now as gold smashes through 4,500 and silver plummets past 72. This video will clarify why this is occurring and how you can ensure it doesn't happen to you. Here is the root cause. The weapon deployed is known as a margin hike. When you trade futures contracts, you post a deposit, typically about 10% of the contract's value. So to control $100,000 worth of silver, you put up $10,000. That is your margin, your stake in the game. If the exchange decides to increase margin requirements overnight, you abruptly need to provide more cash. Not next week, not when your bank transfer finalizes, immediately. If you lack the ready capital, your position is liquidated. The exchange automatically sells you out at whatever price is available at that instant. And when multitudes face liquidation simultaneously, the price available at that instant is catastrophic, rock bottom, the most disastrous exit possible. A single margin hike is survivable. Most traders maintain some buffer, a reserve of cash specifically for such scenarios. But what if there are 2 hikes, 3, 4? What if there are 8 margin increases in 8 weeks? That is not survivable. That is extermination. And that is precisely what the CME executed. 8 margin hikes over 8 weeks, each one engineered to extract more capital from long positions, each one tightening the vice. Throughout December and January, they hammered traders with hike after hike, a Christmas Day hike, a New Year's weekend hike. Every time traders regained their footing, another increase arrived. Then came the kill shot. On January 13th, the CME shifted to percentage-based margins. Now, as the price of silver climbs, your required margin rises automatically, a self-tightening trap. The higher silver goes, the more cash you need, even if you take no action. And they did not relent after Friday's massacre. Monday morning brought another hike, then another one this week. 8 hikes in total. For perspective, all of 2024 saw just 2 hikes. The entire year, 2023 witnessed 3. 2022 had 2. 7 hikes across 3 years was the norm. 8 hikes in 8 weeks is without precedent. I have scrutinized 2 decades of CME data. This is utterly unprecedented. Each hike sets off forced selling. Forced selling drives prices lower. Lower prices then trigger margin calls for other traders who weren't even impacted by the initial hike. This leads to more forced selling, more price declines, a death spiral by design. That death spiral is what you are observing live. Gold at 4,500, silver at 72, and still falling. But here is the element that kept me awake last night. This very morning, on the same day as the CME hike, the Shanghai Gold Exchange also raised margin requirements from 20% to 26%. The CME in Chicago and the exchange in Shanghai, China, separated by 14 time zones, took identical action on the same day in the same direction. America and China, these two nations agree on virtually nothing. Trade wars, sanctions, they dispute each other at every international forum. Yet regarding silver margins, suddenly they are moving in perfect lockstep. That is not supposed to occur unless both are frightened of the same thing. And I believe I know what that is. 356 to 1. That is the paper to physical silver ratio on the COMEX. For every single ounce of actual metal in the vault, there are 356 paper ounces claimed. 1 real ounce, 356 paper promises. This system functions as long as everyone settles in cash. But when entities demand physical delivery, the arithmetic implodes, and people are demanding physical delivery. In the 3rd week of January, 33 million ounces of silver were physically removed from COMEX vaults, not traded, physically withdrawn, loaded onto trucks, gone. That represents 26% of their total inventory in 1 week. 4 years ago, COMEX held 430 million ounces. Today, it holds 113 million. 74% has vanished, and the pace is quickening. 1st week of January, 7 million ounces departed. 3rd week, 33 million. The exit has become a stampede. Who is taking this silver? Not retail investors. Moving 33 million ounces requires logistics, trucks, security, warehouse space. This is institutional capital, manufacturers, sovereign wealth funds, smart money. They are draining the vault, and they aim to do so before March. Here is why March is critical, and this is paramount. March futures contracts represent 528 million ounces of promised silver delivery. That is the quantity owed to traders holding March contracts. The vault contains 113 million ounces. Read those numbers again. 528 million ounces promised. 113 million ounces available. They have pledged almost 5 times more silver than physically exists in the entire COMEX warehouse system. First notice day is March 27th. That is when every trader holding a March contract must declare their intent. Cash settlement or physical delivery. If just 22% of contract holders demand physical delivery, the vault is completely emptied. Not strained, not tight, empty. What occurs when the 23% arrives to claim their silver? This is the nightmare scenario the CME and Shanghai are desperately trying to avert. This is the reason for the coordinated margin hikes. They must shake out the long positions before delivery demands expose the entire system. And it is working. Look at your screen right now. Gold at 4,500, silver at 72. Longs are being exterminated. But here is the smoking gun, the evidence revealing this is not an authentic crash. It is manufactured. Pull up 2 prices right now as you watch this. COMEX silver, the paper price. The figure you see on financial networks, $72 and dropping. Now, look up Shanghai silver, the physical price, the price where real metal changes hands. $100. Same metal, same day, same planet. A $28 disparity. I need you to grasp how insane this is. Paper silver in New York trades at $72. Physical silver in Shanghai trades at $100. That is a $28 gap. That means physical trades 39% higher than paper. If silver were genuinely worth only $72, why would anyone pay $100 in Shanghai? Why would sophisticated Chinese buyers, manufacturers who require this metal for production, pay a 39% premium unnecessarily? They wouldn't, unless they possess insider knowledge. They know the paper price is artificial. They know $72 is a manipulated number. They know the real value of silver is closer to what they are paying, $100. And here is what should truly baffle you. The gap is not closing. On Friday, the gap was $25. On Monday, it was $30. Today, even as COMEX crashes harder, the gap remains $28. Shanghai is not collapsing in tandem with New York. Physical is holding firm while paper disintegrates. Consider the implication. If this were a genuine crash driven by actual supply and demand, both markets would fall together. Paper and physical would move in sync. They are not. Paper is in free fall. Physical is holding steady. That tells you everything. The paper price is being artificially suppressed. The physical price is reflecting reality. One of these prices is a fabrication, and I believe I know which one. Here is who benefits from that fabrication. JP Morgan holds the largest short position in silver of any bank in history, maintained for over a decade. Every dollar silver falls, they profit by hundreds of millions. Bank of America, massive shorts. HSBC, massive shorts. These banks occupy seats on CME committees. They possess visibility into market positioning. They know where the pressure points lie. On Friday, regular traders lost 38%. These banks made billions. Today, as gold crashes through 4,500 and silver through 72, they are making billions more. I am not alleging crimes. Short selling is legal. Serving on exchange committees is legal. I am simply highlighting that the entities profiting most from this crash are the same entities wielding the greatest influence over exchange policy. Draw your own conclusions. The timing from last week also matters. On Thursday evening, Reuters published a story claiming the U.S. government was ending support for strategic metals. Anonymous sources. Algorithms triggered. Selling cascaded. 3 hours later, an Energy Department statement declared, "The article is false and relies on sources that are misinformed or deliberately misleading." False. Completely fabricated. But markets had already crashed. Algorithms do not reverse for corrections. Also on Thursday night, the nomination of Kevin Warsh for Fed chair was leaked. A hawkish pick, negative for metals. The official announcement came Friday morning. Insiders knew Thursday night. Fake news, leaked nominations, 8 margin hikes, all within the same window. Coincidence? And here is something I discovered this morning that no one is reporting. The day before the crash, on Thursday, there was extraordinary options activity on silver ETFs. Massive put buying. Someone placed enormous bets that silver would collapse the day before it happened. Either someone was phenomenally lucky or someone possessed foreknowledge. Now consider what happened to traders who tried to exit. They couldn't. In China, the UBS SDIC Silver Fund was halted. Not slowed, not restricted, completely halted. The entire trading session saw 0 executed trades. No buying, no selling, nothing. Imagine watching silver crash 30% and being unable to sell. Clicking the sell button with no response. Refreshing the page repeatedly, still nothing. Calling customer service, listening to hold music, watching your net worth evaporate minute by minute while the exit is barricaded. That is what happened to thousands of Chinese investors. In the US, the ProShares Ultra Silver Fund dropped 62%. If you held $100,000 on Thursday night, You had $38,000 by Friday evening. 62% of your capital erased in a single session. The iShares Silver Trust fell 31%, its worst day in the fund's entire history since inception. But the price drops weren't even the worst part. Traders attempted to sell. Orders were rejected. Platforms displayed error messages. Systems were overloaded. Customer service phone lines had wait times exceeding 2 hours. And when you finally got through, they stated there was nothing they could do. One trader messaged me saying he tried to close his futures position for 18 consecutive hours. Every single order was rejected. He watched his account drain, dollar by dollar, thousand by thousand, with zero ability to halt it. As of last night, some traders still reported account access issues. Days later, unable to view balances, execute trades, still locked out. They crashed the price, then they blocked the exits, then they raised margins again. Contemplate that sequence. Crash, lock, raise. If you were designing a system to annihilate long positions, to transfer wealth from retail traders to institutional shorts, this is precisely the blueprint you would follow. Now, examine the fundamental backdrop that renders this crash even more irrational. The crash makes no fundamental sense whatsoever. Silver has been in a supply deficit for 5 consecutive years. Solar technology needs it. Electric vehicles need it. AI semiconductors need it. iPhones need it. Demand is exploding. Mine supply is stagnant. The cumulative shortfall since 2019 is 1.3 billion ounces, equivalent to 18 months of global production, simply gone, consumed. And then China locked the door. On January 1st, 2026, silver was added to China's strategic materials list. Export licenses are now required. Export volumes have dropped 40%. China refines 65% of the world's silver. They have effectively told the West to find another supplier. There is no other supplier. And it's not just traders suffering. This crash is devastating businesses globally. In India, within the jewelry trading hub of Rajkot, 44 firms declared bankruptcy last week. Losses exposed total $425 million. Families engaged in the silver trade for generations have been wiped out. In London, 2 hedge funds have suspended redemptions. They cannot return investors' money because their silver positions are underwater and they cannot sell. In Dubai, physical silver premiums have spiked to 15% over the spot price. Dealers cannot secure enough metal to meet demand. This crash is creating wreckage across the entire global financial system, and we are only a few days in. Now, connect the dots. A 5-year supply deficit, exploding demand, China restricting exports, and the price is crashing. This sequence only makes sense if the paper market is being manipulated downward ahead of the March delivery period. I believe physical reality will prevail. I believe it always does. Paper promises can be printed infinitely. Metal cannot. But right now, paper is winning. Gold at 4,500, silver at 72. Longs are being destroyed. So, what happens next? Where does this crash conclude? No one can provide an exact bottom. Anyone claiming certainty is being dishonest. I will not give you specific price targets because in a crash of this magnitude, targets are meaningless. Support levels that should hold are shattering like glass. What I can provide are the indicators to monitor, not price levels, but something more significant. The signs that reveal whether this turmoil is concluding or intensifying. Here is what leads me to believe this is not the finale, and this is crucial. The Shanghai premium is not collapsing alongside paper. Physical buyers are still paying $100 while paper trades at $72. If this were a real crash driven by fundamentals, physical would be crashing too. It is not. Physical is holding. That tells you everything you need to understand about what is real and what is illusory. Lease rates are at 10%, 20 times higher than normal. Institutions are desperate for physical metal. You do not pay 10% to borrow an asset you believe is about to depreciate. You pay 10% because you need it immediately and cannot locate it elsewhere. The vault drain continues. Smart money is still taking physical delivery. 33 million ounces last week, likely more this week. While retail traders panic and sell, institutions are backing up the trucks. They are extracting metal from the system. March open interest remains elevated. Despite the crash, despite the margin hikes, despite everything, traders are still holding March positions. They still want delivery. They have not surrendered. The fundamentals have not altered, not one iota. The deficit is still real. The shortage is still real. China is still restricting exports. Industrial demand grows every single day. The only element that has changed is the paper price. Only the paper price, forced down through 8 margin hikes and cascading forced liquidation. At some point, paper must reconcile with physical. It always does. Throughout history, without exception, physical reality triumphs. The sole question is, how much damage occurs first? How many traders get wiped out? How low does paper go before the manipulation fractures? I believe physical wins. I believe it always wins. Paper can be printed infinitely. Metal cannot. That truth has held for 5,000 years. But here is what panicking retail participants miss. Crashes do not destroy wealth. They transfer it. On Friday, wealth moved from retail to the banks. When this reverses, it will move back. The question is, which side you are on when that shift occurs. Paper at $72, physical at $100. That gap will close eventually. Someone will profit immensely when it does. Here is what I am monitoring. These are the metrics that will signal what comes next. The Shanghai Premium, currently $28. This is the truth teller. This gap between paper valuation and physical payment. If it widens to $40, paper is losing all credibility. If it narrows because physical starts dropping, the manipulation thesis may be flawed. But if it narrows because paper rises to meet physical, that is your signal the game is changing. This gap reveals everything. COMEX vault levels. Data released every Friday. Last week, 33 million ounces departed. If another 20 to 30 million leaves this week, the vault will be nearly empty before March. Who is taking this metal? Where is it going? Why are institutions paying for logistics to move physical silver while the price crashes? They possess knowledge. Lease rates, currently 8 to 10%. Normal is 0.5%. This is the rate institutions pay to borrow physical silver. When lease rates spike this dramatically, it signifies physical metal is scarce. The last 2 times rates hit these levels were 1980 and 2011. Significant events followed both. March open interest. How many contracts remain open for March delivery? If traders are capitulating and closing positions, open interest drops. If traders are holding despite the pain, open interest stays high. Elevated open interest approaching first notice day means delivery pressure, exactly what the exchanges aim to avoid. Trading halts and system stress. Platform freezes, account lockouts. If more funds are halted, if more platforms freeze, if more traders report being locked out, it indicates the system is under severe stress. Functioning markets do not freeze. Stressed markets do. Shanghai Premium, vault levels, lease rates, March open interest, system stress. Track these. The data will reveal what is happening before the broader market comprehends it. A widening Shanghai Premium means paper is losing credibility. Spiking lease rates mean institutions cannot find metal. Freezing platforms mean the system is breaking. These are not mere numbers. They are warning lights. Here is what I want you to comprehend about what you are witnessing. This crash is not random. It is not normal market behavior. It is not merely profit-taking after a rally. It is 8 margin hikes in 8 weeks, unprecedented. It is the CME and Shanghai coordinating on the same day, adversaries moving in unison. It is unusual options activity the day before the collapse. Someone new. It is a $28 chasm between paper and physical, a divergence impossible in an efficient market. It is vaults draining at 26% per week, smart money fleeing to physical. It is traders locked out of accounts, unable to exit. It is 44 firms bankrupt in India, hedge funds freezing redemptions, physical premiums spiking globally. This is not a correction. This is a coordinated assault on long positions, engineered to shake them out before March delivery demands expose the fractional reserve nature of the COMEX. It is working. The attack is working. Longs are being destroyed right now, this very minute. Gold at 4,500, silver at 72. But the fundamentals remain unchanged. The shortage is real. The deficit is real. Physical trades at $100 while paper trades at $72. At some point, this ends. Paper reconciles with physical. It always does. The question is whether you survive until that moment, whether you can endure the pain, whether your stop losses were triggered, whether margin calls forced you out. That trader who messaged me Sunday night did not survive. He was correct about everything, and he was still destroyed. Ask yourself tonight, do I understand my exposure? Do I possess an exit strategy? Is my position sized for survival, or am I one margin call away from losing everything? The victors in markets like these are not those who predict perfectly. They are those who survive, who manage risk meticulously, who remain calm while others panic. Survive until clarity emerges, then act. This is not financial advice. Your capital, your decisions. But if you are watching gold crash through 4,500 and silver collapse through 72, you must understand what you are truly observing. You need the complete picture, the margin hikes, the coordination, the physical divergence, the vault drain. That is what this video has provided, the full context. Gold at 4,500, silver at 72, Shanghai at 100. The gap is screaming. Paper and physical cannot remain this disconnected forever. When the convergence happens, someone will have bought at the bottom. Someone will have held through the anguish. Someone will have perceived what others overlooked. That individual could be you. Or you could be the trader who messaged me Sunday night. The difference is not luck, it is risk management. Share your perspectives on this crash in the comments below. Pass this along to someone who needs to see it. Subscribe. I will be covering this situation daily until it reaches its resolution. I will see you tomorrow.